Good afternoon, and thank you for joining this first webinar in our Retire Ready Financial Wellbeing series. My name is Kirsty Johnson. I work for Somerset as our Wellness Programme Manager, and I will be looking after the webinar today, more so in the background. Because of the way this is set up, we unfortunately can't see or hear you. However, you should be able to see and hear us and be able to see the presentation on the screen. We would like this to be as interactive as possible. So you should see a Q&A function either at the top or bottom of your screen, and encourage you, if you have any questions or comments at any point, to pop those in there, and we will answer the questions at the end when we save some time for Q&A. With that in mind, this session will run for approximately 40 minutes of presentation time, and we will leave the remainder of the hour or so for your questions. So I think without any further ado, I will pass you over to Liz. Welcome.
Thank you, Kirsty, and it's really lovely to be here. And I do want to congratulate Somerset actually for this initiative, because retirement planning is just so important. Retirement can be a third of your life, so it's really, really crucial that you sit down and think about what kind of retirement you want. And the reason I'm speaking to you today is because I've had over 20 years experience as a financial advisor. I had my own business for a number of years. I've now sold that, and I've set up a new business called Enrich Retirement, in which I've brought together all the information that I've accumulated about retirement planning into one spot to make it really easy for people to tap into the information that they need. Yeah, that's why I'm here today. I've written a book. I'm a regular columnist. I write lots of columns, speak on the radio. So you may well have come across my name before. And I just love talking to people about retirement. It's my passion. I'm supposed to be retired myself. It's one of those things of, when do you actually retire? But I just enjoy what I'm doing and keen to pass on my knowledge. So let's get straight into it. First of all, I do want to let you know that I'm going to give you some general information today, and so this is not personalised advice. And I really encourage you, if you've got a burning question, you want to know how something might impact on you, you need to go and talk to a financial advisor. And I think you'll find most financial advisors are willing to help. It's just a matter of finding one that you feel comfortable working with, and just really, get the good answers to those burning questions that you have, because it is such a crucial part of your life. So just bear in mind that this is general advice. Please, if you want to know how it applies to you, go and talk to somebody in a professional capacity. So what are we going to cover today? We're going to look at the really key things that you need to know. First off, calculating how much you need to retire. And this is something that people start to worry about, particularly in their 50s, mid to late 50s. Gosh, what sort of a position am I in order to be able to retire? Do I need to keep on working? How much is enough? And it can be really confusing, because you read newspaper articles that say, oh, you need $3 million in order to retire now, and all this kind of thing. And it can be quite kind of scary. Creates quite a lot of anxiety for people, just knowing how much you need to retire. Then we're going to spend a little bit of time talking about how to do your retirement budget. And most people hate that word budget, but for me, I have a pretty easy approach that I think you can use to working out how much money you might need, and it doesn't involve having to do a lot of spreadsheets and work out exactly how much you're spending on what and tracking every dollar. So we'll talk a little bit about that, because as you know, once you've retired, that's it. What the money you've got is the money you've got, and you need to make sure it's going to last the distance. And then finally, the last one we're going to talk about is how to avoid being asset rich and cash poor. And that's probably one of the biggest mistakes that retirees make, is that they have most of their money, most of their wealth, I should say, tied up in the house that they live in and don't have enough spare cash. So we'll look at some strategies around that. Right, so let's get stuck into it. So how do we work out how much money you need to retire? So I often get asked this question, how much do I really need? But quite honestly, there is no one answer to that question because it depends on so many different factors. Everybody's retirement is different. So to start with, it depends on your health and longevity. So you might want to take a look at some factors within your family to start with. You know, how long did your parents and grandparents live? Is that an indicator of how long you might live? Because the longer your money has to last, the more money you're going to need. It depends on your health. So some people come into retirement with some quite significant health issues that might curtail their lifespan. So, and that, you know, again, it's that same thing of if you're really fit and healthy, you're going to potentially need a lot more than if you're facing some severe health limitations. Or on the other hand, if you do have severe health problems, it maybe you might need some extra money to cover healthcare costs and that kind of thing. So have a look at your health and longevity. And the other key thing is where you live has an impact. So we know, and I'll cover this off a bit later in the seminar as well, that it's a lot more expensive to live in the city than it is to live in a rural location. And this could be a strategy that you can use, in fact, to your advantage, because if you are finding that you haven't got quite as much money as you were anticipating to have for your retirement, then perhaps moving to a different geographic area might make retirement a little bit more affordable for you. So on the other hand, if you want to stay in that city lifestyle, you know, if you're an Aucklander through and through and you want to be central city Auckland or North Shore Auckland and be in amongst all the hustle and bustle, then you're going to need a lot more than if you live in, you know, one of those more rural areas. And we have seen actually with this in the last few years, a lot of people moving out of the cities into rural areas for their retirement. It also depends how frugal you are. And, you know, let's face it, some people can live on the smell of an oily rag, as my father used to say, and are quite comfortable with doing that. They don't need to spend a lot of money on stuff. Whereas other people think, well, this is my retirement. I really want to have a ball and do the things I've always wanted to do and have whatever I want, you know, now that I'm free of work. So it depends where you are on that spectrum. How frugal are you? To what extent do you need to spend money to be happy? That makes a big difference to how much you need. And then lastly, what you want to do in retirement is really important. So, you know, some people want to travel a lot. You know, they might want to do an overseas trip once a year or go on an extended overseas holiday. Whereas some people tell me, look, you know, I've been there, done that, so I don't need to travel anymore. Or others just say to me, look, actually, I'm not interested in travel. I'd rather spend time with my grandchildren or my friends, indulge in my favorite hobbies and pastimes and that kind of thing. So yeah, so it's about the kind of lifestyle you want. So there's a lot that goes into it, which means there's a huge variation in how much money you might need at the end of the day. So you really need to do that thinking first. You know, answer all those questions first, and then look at how much money you might need. And I'll give you a process to guide you through that. So yeah, so if we can flick onto the next slide. So just coming back to, you know, health and longevity. So people are living longer and longer, and women live longer than men. Although I have to say, in saying that, men are starting to catch up with women. So if you are in 2022, if you are aged 65, you could then expect to live to just over 88 if you're a woman, and just around 86 if you're a man. And those life expectancies are increasing year on year. And as I said, the gap between men and women is closing. So I would think you should expect now, if you're doing your retirement plan, to be planning to live to 90, 95, around that kind of range. And it's honestly, we're going to be moving up to 100 before we know it. So my advice is plan to live a long time, unless you know you've got something that might impact on your longevity. The most conservative thing you can do is plan to live to 95, because the worst thing you can do is run out of money before you run out of life. So if you die earlier than what you planned, then I guess, your family gets a bonus, don't they? But it's better to do that than to run out of money. So how much do we need? Well, NZ Super, we know, is not enough to live on comfortably. And a lot of people aren't even aware of what NZ Super payments are. So it's paid once a fortnight. If you're a person living on your own, you can expect after tax to get about $1,038 per fortnight. If you're a couple, it's $1,598. Now, the key thing to remember here is that if a partner dies during retirement, which, usually one person dies before the other, you go on to the single rate, and yet a lot of your costs are fixed. You're still paying the same rates, the same insurance, you've still got the same house maintenance costs. Yes, you're going to pay a little less on food and clothes and all that sort of thing, but a big percentage of your costs are fixed. So moving from a couple's pension down to a single pension can be a bit of a shock for some people. But yeah, we do know that it's not enough to live on, and I'll demonstrate that with some information that we have from Massey University. So every year, Massey University does a research project looking at how much it costs to live in retirement. And they look at the difference between the average living costs and NZ Super. So this is based on the 2023 NZ Super payments, because they do go up every April. They're adjusted by the average wage increase. So we do know that somewhere you'll fall short, as you can see here, somewhere between $400 and $1,800 a fortnight, depending on your circumstances. So you'll see here the differences between living in a city situation and provincial situation. They've calculated here a no-frills budget, which is more the frugal way of doing things, and what they call a choices budget, which is having a more comfortable, luxurious retirement. So you can see that someone living in a city area on a no-frills budget might need an extra $430 a fortnight. This is for a two-person household. If you're on a choices budget, you might need $1,800 a fortnight. If you're in a provincial area, $172 a fortnight, and if you're on a choices budget, another $1,100 a fortnight is what you'll need to top up by, which is quite an astounding amount. So if we look at what that means, if we perhaps go on to the next slide. So what it means is that the lump sum you need in order to generate that level of extra income varies between $92,000 and $969,000, depending on your situation and your choices. So that's a rule of thumb guideline. So you can actually download this report from the internet. If you look up Massey University Retirement Spending Guidelines 2023, you can see the full details there. So as I say, depending on the choices you make and where you live, you could need up to around about $1 million to supplement your retirement, your NZ superannuation for retirement. But that's just really a rule of thumb. So another way of looking at it is to look at how much income you want over and above NZ superannuation per year. So what I've worked out is that you need around $180,000 for every $10,000 of income that you need over and above your NZ Super. So that assumes a 1% net real return. By that, I mean the return on your investment, less tax, less any fees, etc. It assumes that you run down that retirement capital over 20 years. So you start with 180,000 in the bank, so to speak, or invested. At the end of 20 years, you have nothing left because you're using up that 180,000 as well as using up the income that it generates. All right, so if you work out your budget and you think you need $20,000 a year over and above NZ Super, then you would need 360,000 in retirement savings. So that's a bit of a rule of thumb that you can use to work out how much you need. Of course, you can also use a retirement calculator, and there's quite a number of those around. You'll find some on my Enrich Retirement website. You'll find one on the Sorted website, and in various other places to work out what your requirements are. Okay, so moving on, budgeting for your retirement. How do we do that? Because your living costs in retirement are different than your living costs when you're still working and still have a family. So you really need to go back to the drawing board and look at what you might need, and this will help guide you in terms of how much per fortnight or per annum you'll need over and above NZ superannuation. So the easiest way to look at it, I think, is to look at the types of spending that you will have in retirement. And basically there's two categories. There's what I call the day-to-day living expenses. That's money, expenses that occur every week on a regular basis. So, food, power, phone, etc., etc. Then you've got your lump sum spending. So that's big amounts that you spend on an ad hoc basis. It's like one-off spending, such as replacing a car, that sort of thing. So the main thing to get a handle on is what your daily living expenses might be, and work that out. So what we do for that is we break that down into 3 different categories. And this makes things really easy. So normally you'll find your expenses fit one of these categories. So first off, we have your known expenses. So these are expenses that we can't do a lot about. So, rates, insurance, your vehicle licensing costs. We generally know how much these expenses are, and we know when we have to pay them. And we have to make sure we set aside enough money to cover them. And gosh, we all know that rates and insurance are going up significantly at the moment, and they can form a huge part of your budget. Rates can be $5,000 a year, insurance can be $6,000 or $7,000 a year. You add that up, and a big chunk of your NZ superannuation is gone. So start by working out those things that you don't have any control over, because you have to pay those regardless, unless you do something really significant like selling your house. So we have to cover those off. Then at the other end of the spectrum, we've got discretionary expenses. Now, we all have to have some sort of discretionary spending. That's the fun stuff. That's going out to shows, going out to dinner, having coffee with friends, buying gifts for your grandchildren, all that sort of stuff. So it's all spending that you don't have to spend that money, but life would be pretty boring if you didn't. The thing is that discretionary spending can get away on you if you're not careful. So my advice around that is to have a set budget for it. It's a bit like paying yourself some pocket money in a way. So, give yourself a weekly allowance or a fortnightly allowance for your discretionary spending. And when that money's gone, that's it. Don't be tempted to dip into your other money, because that will then start to erode into the other goals you have for retirement, or might start eating into your rates money and insurance money. So we take care of that, and then in the middle we've got what I call household expenses, and these are expenses where we do have to spend some money on them, but we can control to some degree how much we spend. And quite honestly, the biggest category there is food. You know, we all have to have food to live on, but you can go into the supermarket and you can put, you know, $200 worth of food in your trolley, or $500 worth of food in your trolley, depending what your buying habits are and depending how frugal you are. So food is a really important one to keep tabs on. And again, I would encourage you to have a budget around all these kind of things that are, you know, we know that they're essential, but you need to sort of keep a lid on exactly how much you're spending. So I find having these three categories and even having separate bank accounts for them is a really good way to go. And for your discretionary spending, I always advise people to have, you know, if you're in a couple relationship, have your own discretionary expense account, because then it saves all the arguments about, oh, you know, we can't afford this, we can't afford that, and how dare you buy that new pair of shoes, and gosh, aren't your haircuts expensive? You know, I think yeah, and us women always need more, I have to say. But I think if there's an agreed budget for each partner in a relationship, then there shouldn't be any arguments over that discretionary spending. So yeah, save yourself some grief by having separate accounts for that. Okay, so then the lump sum expenses. So these are things like travel. You know, you might want to plan out, you know, half a dozen overseas trips or so. You might be thinking, well, gosh, we might need a new roof on the house, or the house needs repainting, need a new car, or we might need some healthcare, perhaps some hearing aids or cataract operations, that kind of thing. So it does help to sort of plan out a time frame of the rest of your retirement and look at when those expenses might occur and how much money you might need for them, so that you can plan ahead and make sure you've got that money set aside, right? So we try and get that balance between, you know, making sure you've got your day-to-day living costs covered, and then making sure you've got enough to cover those other big lump sum items. And if you add all that together, you'll start to get a picture of how much money you might need for your retirement, and therefore how much of a lump sum you're going to need. Okay, moving on. So retirement, as I said, lasts a long time. And, you know, how do you plan ahead for the next 30 years? That's not easy. Who knows where we're going to be in 30 years' time and what might happen in between. So my advice is to chunk up your retirement into different stages, because it's a lot easier to plan ahead for next year or even the next 5 years than it is to plan ahead for 30 years. So my advice is to break it up into what I call the 3 different stages of retirement. So generally it follows a pattern. So when people first retire, they go, woohoo, I'm out of here, I'm going to do my overseas travel and have a whole lot of fun and play golf and, you know, go out to dinner with my mates and drink lots of wine, etc., etc. So that's what I call the live it up stage. And you do want to make the most of that, because you never know what's going to happen with your health. And I get that feedback a lot of the time, especially if you know, if you've had parents who've died young or had a serious health event in midlife, mid-retirement, or you might know friends who've had the same. So, you know, you do want to make the most of it. And your live it up stage can be as long as you like. That might be the first 5 years of your retirement, might be the first 10 years of your retirement. That's up to you to decide that. So have a look at what you might want to do in that live it up stage, you know, where you're really, you know, enjoying yourself and, you know, this is what you've been working for all your life, etc., etc. what I tend to find is that after the first 10 years or so, we move into what I call the fix it up stage. This is a bit of a depressing story as we go through, because what happens is that bits start to fall off. So your, metaphorically, so your health can take a turn for the worse in mid-retirement. So I'm talking, 75 plus. You can start to have your health problems, need your hearing aids and cataract operations and so on. And you quite often find that this is the time when your house might need some maintenance, or you need a new car, because what tends to happen is people will gear themselves up when they first retire. Everything's looking sweet. We've got the house all up to scratch, and we've got our new car, and et cetera, et cetera. But 10 years down the track, it's not looking so flash, and it all needs redoing again. So plan for some things around that stage. So that stage could last, another 10 years. And then, of course, we've got the end of life situation. So it does pay to think ahead about where you want to be living at the end of life. Do you want to be in a retirement village? Do you want to be in your own home? Might you end up in a rest home? Who's going to look after you? A number of people don't have any close family on hand, in which case, the retirement village type scenario is a good one, or you might have to pay for extra care, for people to come and look after you, that kind of thing. So, thinking about it doesn't commit you to anything. I guess you just do want to keep your options open to plan ahead for that part of your life, to know that you've got funds set aside for that. So what we're talking about here with these 3 stages is really planning out those lump sum expenses as much as anything, to look at what you might need to spend and when for those 3 different stages. And as I said, the first live it up stage will be the clearest one to you, and the other 2 will be a little bit vague at this stage, but as you go through your retirement, hopefully you'll be revisiting your retirement plan. Okay, moving on. So what we do then is put it all together. So we have those 3 stages, and we make a list of all the things that we might want to spend in each stage, and we add them up. And of course, this is where the rubber hits the road, and you compare that to what's in your retirement savings, and you might have to go back to the drawing board. So you'll notice I've in this slide I've put travel also in the fix it up stage, because just because you're in your mid to late 70s doesn't mean to say you aren't going to travel. So there's a bit of a crossover between the 3. They're not entirely separate categories, but it just gives you a kind of a framework, if you like, to work out what your lump sum spending might be through your retirement. So hopefully you find that useful. Right, so now moving on to our last area that we're going to talk about, how to avoid being asset rich and cash poor. So firstly, what does that actually mean? Because we do hear the term bandied about a lot, and basically what it means is where there's an imbalance between the value of your house and the value of your investments. So and that means there's a problem in accessing your wealth or accessing cash when you need it, because it's all tied up. And we hear a lot of, well, I mean, I'm a counsellor actually on the Kapiti Coast District Council, and I constantly hear from the retired people in my community, oh, how can we afford the rates? You keep putting the rates up. And that's a very common cry throughout New Zealand, I think. So you need to avoid that situation where you can't pay those essential bills, rates and insurance and so on, by making sure you've got enough free cash available outside your home. So my little rule of thumb is you should probably have something like about 50% of the value of your home available as free cash. So if you're living in a home worth $1 million, say, then you should have maybe up to 500,000 invested. Now, that might be a challenge for some people, I know, but and it also, it depends on, you know, the answers to all those questions we talked about before in terms of what kind of retirement you want, where you're living, whether it's city or rural, et cetera, et cetera. But you need enough free cash that you don't have to worry about paying those financial commitments. So what can you do if you're in that situation? And of course, the other problem that we have too now is that a lot of people don't own their own home as they go into retirement, or still have a mortgage on their own home. And this is becoming an increasing problem due to, you know, for a whole lot of different economic reasons. You know, people are ending up in retirement in not very good shape. So I'm talking here in this section about people who do own their own home. So if you are in that situation where you own a home, you can look at obviously downsizing your home. And I don't mean that in the sense of moving to a smaller place, because quite often what happens is people sell their home, move to a smaller place, but it's actually more expensive or the same value as the one they've sold, because it's more modern, it's got, you know, all the insulation, all the mod cons and that kind of thing. So when I talk about downsizing, I mean freeing up money, and that might mean moving to another suburb in the town that you live in. It might even mean moving to a different town in order to achieve that. The next thing you can do is continue to add to your investments to get that balance right. And really the only way to do that is to keep on working. So if you're in that situation where you're getting close to 65, you've got your debt-free home, but not a lot of cash. If you don't wish to downsize your home, then maybe you need to keep on working and add to your investment portfolio to get the balance right before you retire. You can also do a reverse mortgage, and that's becoming very popular now because, you know, it doesn't really impact on you as such. It impacts on the beneficiaries of your estate, your children, usually. So, and with a reverse mortgage, you can tap into the equity in your home, the value of your home, by taking out a mortgage on which you don't make any repayments during your lifetime. It does have compounding interest on it, although you can choose to pay the interest if you don't want to have compounding interest. And when you pass away or the house is sold, the loan is repaid at that point, and the remainder goes into your estate. So that's becoming a very popular way. It's normally used as a last resort type option. You know, if once you've used up your retirement savings, or if you're in a situation where for health reasons or whatever, you simply can't add to your savings, or you've had something happen during your retirement and you're faced with living in poverty, or doing a reverse mortgage. So again, with something like that, you should definitely talk to a professional advisor about that as an option if that's the situation that you're in. And the other thing you can make sure you can do is to run down your investment capital. So a lot of people are, of a mindset that they just want to live off the returns on their investment capital and not use the capital itself. So in other words, if you've got 100,000 invested, you live off the interest off the 100,000, but you don't spend any of the 100,000. Well, that really today doesn't work as a strategy for retirement. It probably means you're going to end up living in poverty in retirement if you do that. Okay, next slide. So in retirement, it's better to talk about cash rather than income. So in retirement, the key thing you're interested in is getting your hands on some money. And it shouldn't matter to you whether that money comes by way of the return on investment, or whether it's from the actual capital your investment capital. So in other words, if you've got 100,000, you can tap into that 100,000, because the most important thing for you is to have money available when you need it. And quite honestly, if you choose to try and retain your investment capital, so in other words, retaining your 100,000 I've been talking about, you will need significantly more than if you're prepared to tap into your retirement savings and run it down. And I'll just show you in the next slide how that works. So we talked earlier about how if you have 100,000 of retirement capital and you run it down over 20 years, that would generate 10,000 a year of retirement income. That's the little rule of thumb. Now, if you chose not to run down the capital and you still wanted the 10,000 a year income, you would need about $1 million invested to get that same result. So you can see that it just really doesn't make sense to try and hang on to your money because, you know, let's face it, you can't take it with you. What are you hanging on to it for? You know, you need to think carefully about how you want to provide for your children. You know, to what extent do you want to provide for them over and above what's invested in the home that you live in, whatever that shape or form that might take. So really think hard. There's a balancing act here between your needs and the needs of the beneficiaries of your estate or your children. And there is absolutely no point in living in poverty in your retirement just so you can hand over a bigger amount to your children when you pass away. That just does not make sense at all. You have to get that balance right. I mean, you know, you often hear that term ski used, you know, spending the kids' inheritance. You know, I guess, you know, the bulk of the people I talk to say, well, you know, the kids can have the home and whatever's left after, you know, we've had a good crack at spending it. And that's a pretty healthy way to be. And quite often these days, you know, people are more interested in helping children get into a first home or something than leaving a big inheritance behind. Right, next one. So just in summary, so the key points that I hope you've got through from today, you know, you do need to think ahead about what kind of retirement you want, as per those questions we had at the start of the webinar. You know, what are the things you're going to do in retirement? How long might you live? Are you frugal or are you a bit more of a spendthrift? Make sure you plan to live a long time, because that's going to give you the best outcome. You then won't be in danger of running out of money before you run out of life. Break your retirement up into chunks, because it's not easy to plan ahead for the next 30 years. So just look at it in stages. You know, you live it up stage, you fix it up stage, you're winding down stage, and really try and put yourself into those different stages and think about what you might be doing in each of those stages and what you might need. You know, just try and get a crystal clear image of yourself when you're 75 or when you're 85. You know, what does life look like for you then, and plan accordingly. Find the right balance between how much money, how much of your wealth is tied up in your house. Don't be asset rich and cash poor, because, you know, I just often joke to people that, you know, if all your money is tied up in your house, you'd better jolly well have a nice view out your lounge window, because you won't be able to afford to go anywhere. So get that balance right. You don't want to have everything in your house and you can't afford to enjoy life. Focus on your own needs first. You know, don't be all, you know, anxious about leaving that big inheritance for your children. You know, quite often kids these days are much better off than we are anyway. They can take care of themselves. But yeah, you can give some thought to setting some money aside if you wish to. And sometimes people do that in their investment portfolios, have an inheritance, some that stays invested, which, you know, you can then tap into if you need it. So those are the key points. I hope you found that interesting, and it's given some useful guidance for planning your retirement. Now, where to from here? And I think we've got some resources available. So Kirsty, would you like to perhaps just talk a little bit about what Somerset's doing there?
Yeah, certainly. So I mentioned at the beginning of this session, so we have our Retire Ready Financial Wellbeing series, and to support that, we have set up a website. So you'll see the address here, www.somerset.co.nz/retire-ready. And on there, you will find a recording of this webinar, so it won't be up straight away, but we have recorded this session, so it will be available to view again at a later date if you would like to. We also have our free Retire Ready planning workbook. So that is what Liz has compiled. And it will basically take you through a lot of what we've spoken about today, step-by-step stages, allowing you to sort of plan through what your own retirement looks like. And by downloading that workbook, you'll also receive a 40% discount code. So that gives you access to Enriched Retirement's premium membership. So Liz will talk a wee bit more about Enriched Retirement just now, but yeah, Liz.
Okay, yeah, so please have a look at enrichedretirement.com. As I said, I've put together all my knowledge that I've accumulated over the last 25 years or so into that website. And I also have regular interviews with experts on various topics, you know, anything from keeping fit to checking out your hearing to some of the emotional sides of retirement. There's even a little course on intimacy in retirement. So, and a yoga class as well. So there's all sorts of things in there. There's something for everybody, I think, on that website. Plus there's a lot of articles, there's calculators, there's all sorts of things good. So go and have a look and by all means use that discount code to if you'd like to sign up. There's no commitment to stay signed up. You can join for a month if you want to and then cancel, or you can join for a year, whatever you wish to do. So it's quite flexible. And then, of course, we do have the next webinar, which will be on savings and investment in retirement. So that's on the 21st of August. And I'll be going through, you know, once you've worked out what your lump sum is that you need for retirement, where on earth do you put it? How do you invest it so that you get enough money on a regular basis to cover those daily living costs and enough money to pay for your lump sum, you know, one-off expenses as you go through those 3 stages of retirement. So that's what we'll be covering there. And I do encourage you in advance of that to send some questions about that topic so that we can cover them off in the webinar if we have time. So back to you, Kirsty. I think you have a...
Yeah, I was just going to say the email address is there on the screen, retire.ready@somerset.co.nz. If you do have any questions for the next webinar or any feedback you would like to share from this one. For those of you who are online today, you will have already registered for the next webinar, so you should receive a reminder for that. And yeah, we have 3 more of these sessions planned, these webinars, the next one being, as Liz said, savings and investments. And the last one in November will be a purely Q&A session. So please, as we go through any kind of burning questions that you haven't had a chance to answer, make sure and send them in ahead of that session because we will aim to answer as many as we can. And moving on to our questions. So that implies we're finished for today, which we are not. I will just stop our screen so you can see Liz better. So we've actually had one in advance, Liz, to our Retire Ready inbox. So that was regarding KiwiSaver. So this participant has their KiwiSaver in a growth fund, and they're wondering, should they take it out once they stop getting the government contribution, or should they leave it in there for longer?
Okay, so a really good question. A lot of people wonder what to do with KiwiSaver when they retire. So you don't need to withdraw your KiwiSaver funds, and I encourage people not to do that. The reason being that you need to have money invested right through your retirement. So often people think, oh, you know, the minute I retire, that's the end of my investment time frame. Well, actually, no, it's not. You need to have money invested right up to your 90s, and you need somewhere to have that, you know, to keep that money. So it can form part of your investment strategy. It's something I'll talk about in the next webinar in a lot more detail. So my approach to investing money in retirement is to match your investment strategy to your investment time frame. So you might not want to have all of your money in KiwiSaver for retirement, but there might be some you keep in there. You need to have probably some money in the bank to cover your short-term needs. And then you need to think about those 3 stages of retirement in terms of how much money you might need in each stage and invest it accordingly. So money that you're not going to use for 10 years or more could quite easily go into a reasonably long-term investment. And that's where KiwiSaver can be useful. A lot of people also use KiwiSaver as a just-in-case fund. Some people find that as they get older, their health insurance premiums, for example, become unaffordable. And so they might keep some money in KiwiSaver as a just-in-case fund in case they need to spend money on healthcare. You can also use KiwiSaver as your inheritance fund. You can set aside however much you want into KiwiSaver and say, right, well, that's how much I want to have left over and above my home when I pass away. That money's invested for potentially, up to 30 years or so, and just leave it sitting there. But it also means that by keeping it in your control, if you need to, you can tap into that money. So there's lots of ways you can use KiwiSaver in retirement. So don't close your account. If you have closed your account, you can still reopen one. And really it's about thinking about, how long do I want that money invested for? Yes, and again, you might, I would strongly recommend you get some personalised, professional advice on that.
Thank you for that, Liz. So we have another question here. I still have a mortgage. Should I focus on paying that off or adding to my retirement savings?
Right, interesting question, because as I said, there's a lot of people coming into retirement now who do still have a mortgage, and that's not a great situation to be in, I have to say. The rule of thumb always is to get rid of debt before you invest, and I'm a big fan of that. So I would encourage someone in that situation to really plough all their savings into reducing the mortgage as a first priority. So if you can get that mortgage paid off by the time you retire, and then what you need to do is look at that balance, between how much is tied up in your house and how much you have available to invest. And it might mean that at that point you rejig things and perhaps downsize your home or keep working a bit longer or whatever to get the balance right. Because as I said, you can't retire just with a freehold, a debt-free house. You need to have savings over and above that. We've demonstrated that with the Massey University study. So you're going to have to do both, but first priority is to get rid of that mortgage.
Another question we have is, I'm worried by the time I retire, the government will have scrapped New Zealand superannuation as it's no longer affordable. Am I right to be worried?
Look, I think it would be a very brave government that scrapped New Super. I think the worst that can happen is that the retirement age will be increased, and National has a policy on that. So, but depending how close you are to retirement, you may or may not be affected by that, because when they do things like increasing the retirement age, there's always a transition phase. And so it would normally exclude people who are, within a few years of retiring. So, there are a number of issues around NZ Super, and I know from time to time the Retirement Commissioner has called for a review in certain areas. It's putting the age up. In some way it's good because a lot of people are now working, we know a huge percentage of people continue to work past the age of 65, so it's kind of reflective of that. But then what about people who are in very, physically demanding jobs, builders, painters, and so on? And what about Pacific Islanders, for example, and Maori, who have a much lower life expectancy? So by putting the retirement age up, you're actually quite severely impacting on those people because they have less time available to enjoy their NZ Super. So it's a bit of a fraught area, and I think what really needs to happen is there needs to be an inter-party agreement so that we have certainty around it, because that uncertainty, causes people to lose sleep at night and to keep on working longer than they should because they're worried about, am I going to keep on getting my super or not? So I think it's an area where the politicians really need to get together and say, well, look, we all jointly agree that this is what the situation is going to be, and then people can plan accordingly. So, I think the more you can create certainty with retirement planning, the easier it is, and the more you can enjoy your retirement, and that applies, across the board. That's why I say to people, just plan, do your homework, know what your retirement expenses are going to be, think ahead about what might crop up by way of spending needs, and make sure you've planned for that. Because once you do give up your job, it's quite difficult to get back into the workforce. So you want to time that retirement decision very carefully, or find a way to transition into retirement with perhaps some part-time work. To the longer you can work, the easier it is, because you'll save more and you've got fewer retirement years that you need to cover off in terms of topping up your income.
Thanks, Liz. And I think we have one more. Yeah, good questions. And we have one more, I think, before we finish off the session for today, unless any more pop up. You've talked about using up your retirement money, but I'd like to leave something for my children. How do I find the balance here?
Okay, well, that's very much a personal thing. And some people do want to leave a big inheritance for their children. Some people say, well, they're lucky to get whatever they get. But you can, as I alluded to earlier when talking about the KiwiSaver question, you can set aside an amount that you kind of park and invest long term, so that you know that you've covered that off. If it's really important to you to leave an inheritance, then compartmentalize that money, invest it, and you've covered that off. That means you can spend everything else without feeling guilty, and you also know that you can tap into that kind of inheritance fund if you need to as you get near the end of life. So yeah, but it's everybody's different on that score. It depends on the circumstances of your family. You might have family members who are struggling and you want to help them out. Depends on your values in life. Some people like to let their children make their own way and not expect any inheritance. So it's one of those questions that doesn't really have a definite answer, but does require some thought.
Sure. Well, I think that is all of our questions for today. So we're finishing pretty much bang on time. Thank you very much, Liz, for your time today and for all your information and advice. It is much appreciated. And thank you all to those of you who have joined us today for our first session of Retire Ready. It has been our pleasure to have you here with us today, and we look forward to welcoming you to the next one. And again, if you would like to visit our website and download any of our resources, we would love to see you there too. So thank you all very much for your time. Thank you, Liz. And we look forward to seeing you at the next Retire Ready seminar.
I really enjoyed it. Thank you.
Super. Then take care, everybody, and we will see you in August.